Today I'll be talking about inflation and why the price of goods keep going up every year. And I'll be talking about a little bit about the history of money. And before they had money, they used to use a bartering system, which basically means people would trade one good for another. So for example, let's say I have this tweezer and somebody makes, let's say, this battery. We would trade batteries for tweezers. Or let's say I have oranges and someone else has apricots or peaches, then we would trade for different commodities. So such a system was very inefficient. So people came up with coinage or money like that. So this is a coin from, let's say, the Song and the Ming dynasties. Something called a copper cash or something. A merchant used to carry a lot of these in a ring, and people accepted this as money. And these are basically made out of copper and brass and stuff like that. And countries also minted coins out of copper, like this. This is a wheat penny. I think this is about more than 90% copper, from 1952, I think. So pre-1982 pennies in the United States are, let me see how much copper is in them. I think it's more than 90%. Let me check. Pre-1982 pennies. Copper content. Okay, so this pre-1982 penny is 95% copper. Before 1982, pennies had 95% copper. The pennies that we have today have 95% zinc and 5% copper. So back in 1987, when I was walking around my neighborhood, some old woman, maybe she was in her late 70s or early 80s or something, asked me to help her lift some stuff in her house. She was an old woman, and I helped her. And then she paid me in, I think the coins were from 1943 or something, 44, 45, something like that. They were quarters and half dollars from the 1940s. And those coins are, let's see how much silver it has in it. Okay, so pre-1965 quarters, half dollars, dimes are 90% real silver. Okay, so the coins that we have today, which we call quarters, dimes, and half dollars, and basically the amount of silver that was in a quarter depends on the weight of a quarter, but it's 90% silver, basically. So it says a pre-1965 quarter has 6.25 grams or 0.1808 troy ounces of pure silver. Okay, so let's see what the value of that is today in relation to silver prices. So let me check the silver price. So silver is right now $31.76 per troy ounce. So So it says it has 0.1808 ounces of troy ounces of silver. That is right now a quarter from back in before 1965 is worth $5.74. That's for just a quarter. That the face value of the quarter from that period is worth $5.74. So it's worth more than a quarter, right? About 22.97 times the value of the face value of the quarter, basically. And back also pre-1965 dollar bills. So these are modern dollar bills that we have today. The old ones that we had said it was a silver certificate. That's what is stated on the bill. It was a silver certificate. But this is a bill. This is not a certificate for anything. It says this note is legal tender for all debts, public and private, which says right there, as you can see. It doesn't state that it's a silver certificate, which were the bills that they had before 1965 and before 1933. A $20 bill used to say it was a gold certificate. A $20 from before 1933 was called a gold certificate. This is not a gold certificate, right? So basically, let's see how much gold was back in 1922 or something. Okay, a troy ounce of gold was $20.67 in 1922. So this $20 is equivalent, the price of this $20 right now, a troy ounce of gold is $2,669.80. So $20 back in 1922 or pre-1933 is worth $2,669.80 today. However, if you just had a $20 bill from back from 1922 or before 1933, and you took it to a bank and you say, I want a gold certificate. Well, you know what? They're not going to give you a gold certificate. They will not give it to you. They will respect the value of the nominal value, which is $20. But they're not going to give you the full purchasing power of that money when it was minted back in, let's say, 1922. So let's see how much value that it lost compared to 1922. How much value did it lose, actually? It has lost 99.25% of its value. So it's lost almost all of its value. So this money is basically not worth very much. If you let's say you were living back in the 1930s, okay? Let's say 1930. And you just took all your money and you buried it, you put it in a barn somewhere, and you had like let's say $2,000. Back then, $2,000 was a lot of money back in the 1920s and 30s. That was a lot of dough. And you just put it in a barn somewhere. it would have lost 99.25% of its value. But if you had gold like this, if you had a gold coin, you had $20 gold coins like this, and you hid it in a barn somewhere, and you had, let's say, $2,000 in gold, then let's see how much that is. $2,000 in gold. That is about 100 troy ounces of silver. In today's value, that is $266,980. You would have, if you saved your $2,000 in gold, you would have that much right now. You know, your purchasing power would have been saved. And let's see how many times that is. How many times gold went up from 1922? Okay. It went up 133.49 times from 1922. So obviously, if you save your money in this, you know, your purchasing power is preserved for all time. It doesn't matter. You could have been living in, let's say you're an immortal or something, and you were living in 500 BC or something, or BCE, and you saved all your money in gold and, let's say, silver too, like that. You saved all your money in gold and silver. Well then, all of your wealth would have been preserved for the past, see how many years is that? 2,524 years. All of your purchasing power would have been preserved. But if you saved it in, let's say, the currency of the time, whatever empire or dynasty that was, maybe you were living in the Greek Empire or something, or you were living in, let's say, the Zhou dynasty or something, Zhou dynasty, or you were living in the time of the Han dynasty or whatever, or Roman Empire, then all of your purchasing power would have melted away, right? So something like this would be a sure way to save your wealth from any kind of confiscation, whether that be the government debasing the currency, which has happened many times throughout history, and it's happening even today. And it really hasn't changed very much. Maybe the economy definitely got better in terms of like industrialization, automation, and all that. Probably helped boost the economy by boosting the productivity, right, of the economy. Like if you can produce a million nails versus producing 10 nails, you know, that does add to the boost of the economy. You know, that does boost up the economy. Or farmers are using, say, the Haber process or different scientific methods to increase crop yields, right? That does improve the economy, right? That boosts the GDP and everything. But the basic fundamental fact is, you can print more of this if you have a very productive economy. But if you don't have a productive economy and you just keep printing out more and more of this, then you will have inflation. That's what we are going through right now. We're just seeing a lot of inflation, and you know, governments could keep this up in many ways. what they can do is they can issue out bonds. That's what governments do. Sometimes some governments force their citizens to accept these bonds, even if they don't want to accept it. They say you're accepting it, and we'll pay you back in 30 years at let's say 5% interest. But in fact, the real inflation is, let's say, more than 5%. It's more like 20%. Then the money that you get paid back in 30 years is going to pretty much lose most of its value, right? So basically, inflation is good for debtors, but it is bad for savers. So I think that's how they're going to play this out in the next 5 to 10 years. You know, they're probably not going to keep interest rates very high. They're probably going to keep it less than the rate of inflation. So let's say the real inflation is 10 to 12%. Well, then the Fed, they could get the central bank or the Fed to lower it to 2 to 3%. So in that kind of scenario, buying bonds would not be a good idea. The better play would be maybe putting your money in the equities market, stock market, putting it into real estate, putting it into precious metals, maybe putting it into other tangible assets would be a better play. If you know, that's going to be the policy. The government's just going to keep spending, and they're not going to stop, and they're going to make all of you pay for it with inflation. So that's what usually happens during wartime. The government has to print a lot of money to fight the war and win the war. So you have a lot of money in the economy and not a lot of goods in the economy. That causes inflation. More money chasing after fewer goods is what leads to inflation. So I don't know how much silver is going to be in the future, but I could bet that if this fiat currency loses a lot of value, then silver could go up to a lot, you know. But it's going up a lot because this is just being devalued, right? Everything else will go up as well, like your cost of living. And people say, you know what, my house is paid off, so I don't have to worry about inflation. That is BS right there. If you really think about it, that's BS, because you have stuff like car insurance, right? Health insurance. You may have, if you own a home, you may have a homeowner's insurance. And all of this will go up because the people who work in those companies are going to demand more money, right? And that's going to cause those fees to go up. It's not going to remain steady, right? If the cost of a home goes up, then the homeowner's insurance goes what? Up. And what else goes up? Your property tax goes up because the home value goes up. It's a percentage of that. It may be 1 or 2% or something. What is 2% of, let's say a house went up to $2 million? 2% of that is $40,000 a year. 2% of $2 million. 2% of $1 million is $20,000 a year. So as you can see, it does affect your life, you know. Food prices will go up, of course, because, you know, it costs more for the farmers to grow this food, right? They'd have to put in stuff like chemical fertilizers, all these inputs, the costs of transportation, the price of fuel would go up, right? I mean, it's all relative. I mean, all the prices just go up because the cost of living goes up. If the cost of living goes up, meaning your cost of living, right? The basic materials that is used to make stuff like, well, I guess a strategic resource would be something like oil or bauxite, aluminum, iron ore, copper, uranium, natural gas, LNG, and everything else would all go up at the same time, because you can't just have one thing go up and not affect another thing. Everything goes up at the same time because the cost of living goes up. So this would be a tremendous burden for people who are retired, you know, because they are living on a fixed income, and also people who work W-2 jobs, like people who have some fixed salary that doesn't really go up with inflation. People like that would get wiped out over time, you know. So that's what I want to share with you today. So basically, it's not bad to have some gold, but I really don't recommend having too much of this, because it is expensive. You should save some of your money in precious metals, some of it, maybe like a percentage, who knows, maybe 10% of your monthly or weekly salary or something. You could put it into some precious metals, and you could invest your money as well in the equities market, because equities go up with inflation, you know, and it's a lot more liquid than precious metals. Equities are. You can buy and sell it quite easily. And a lot of times what I was doing for years was just investing in not individual stocks, but just stock indexes, which means, like, let's say the Dow index, you know, the Dow Jones index, or something like an ETF, right, for gold, an ETF for gold. It's not one-to-one in relation to the ratio from, if you compare from year to year. Sometimes it is very close to one-to-one, but usually gold is, the return for gold, physical gold, is a little bit higher, but the problem with this is you have to store this. But with an ETF, you don't have to store it. You could just simply sell it and just get your money right out of it very quickly. Selling stuff like this, well, you can do it, but it's a hassle. You have to mail it to the dealer. The dealer has to check it, and then they cut you a check or whatever. This could take a week or something, but if you just trade an ETF, you can get it as fast as just running your credit card or something, you know, because it's electronic. So that's it for this video. I'd like to hear about your thoughts, and you could leave it in the comment section below. Thanks for watching.